Hi everybody, today I'm gonna talk about dividend stocks and what are the dividend aristocrats, what are the pros and cons in investing in dividend stocks. Let's start first defining what a dividend stock is. Dividend stocks are those which pay a dividend to the shareholders. So the dividend yield is determined by taking the yearly dividend payment and dividing it by the stock price. A company is a dividend aristocrat if it increases the dividend it pays to the shareholders for at least 25 straight years. They tend to be large, established companies that no longer enjoy supercharged growth. Many are largely recession proof, enjoying steady profits and growing dividends in good times and bad times. In the article here from Money Invest Expert, very good article, we see they built a dividend aristocrats index. And let's see now an example of what these dividend stocks are. There's a historical performance about the dividend aristocrats in general. You can read in this article, and the total return that you would have had if invested since 2002. Okay, so we are talking about here the U.S. market. So in the U.S. market, you can see that mostly we have energy, consumer discretionary, consumer staples, industrials, financials, real estate, healthcare, basic materials. You can already tell that there's not much technology. You're not gonna find the Apple. You're not gonna find the Amazon, the Google, the Meta. As I said before, these are more old established companies that are attracting the investors with the steady income, the income investors. You need to be aware of some value traps though. The first sign of a value trap can be when you see a company paying a much higher dividend yield than its peers. As the stock price falls, the yield rises, making it appear attractive, but dividend gains are being offset by capital losses on the stock purchase, which could signal there are issues. A value trap can also occur when earnings or cash flow growth is falling, yet the dividend yield is rising or remains elevated. Little cash is also an issue, as dividends can be paid out without cash, or the company must quickly attempt to raise cash, potentially adding to an already troubling situation. So let's see in the UK market what are the most important the dividend aristocrats here. These are paying dividend above 5%. Rio Tinto, British American Tobacco. So you can see mostly we're talking about oil, we're talking about commodities, some financial services here. You need to be, of course, aware. We see a few more here. There's pharmaceutical companies as well, Vodafone, and some, of course, REITs. So some house builders, they pay, especially in the UK, they pay very high dividends. So important here is that you don't jump, as I said before, to buy the stocks with the highest dividends. We can see in this article from Yahoo Finance that there are some dividend stocks here that are probably too overvalued, and they recommend selling. Of course, this is something that you need to decide yourself. You need to do your own research for any of these stocks that you want to invest in. And let's see what could be the reasons for not keeping these dividend stocks in your portfolio anymore. For this company here, BIG, they say, unfortunately, the condition of the economy have drastically changed, resulting in rising inflation and lower consumer demand. So even if this company has performed really well over maybe the last 10 years or even longer, now the market's condition could have changed, and therefore you need to reassess your investment. So don't blindly look at the dividend yield. So they say that the cash flow is getting negative, so this is a very bad sign. So they might even keep the dividends, but the stock price might drop, so it wouldn't make much sense to keep these companies. Another one here, CPB, is we want to avoid decline in earnings. So basically, a company that is no longer growing and is growing maybe, I don't know exactly much about this company, but another thing to consider: check the earnings, check the cash flow. Intel is a big company. Intel has done very poorly in the stock market in the last year. They used to have quite a bit of cash flow, but then they made investments and they are now not in a great position, so their dividend is probably too high now at this stage. Then Dominion Energy is another example. You might think, okay, maybe the business is fine, but then you're faced with worker shortages, so that means you have to raise salaries to be to get the best talents, and then rising fuel costs, we know inflation. So even maybe a very good company could have had these issues and is now not in the same position. This is a pharmaceutical company, TAK. Pharmaceutical companies tend to be quite volatile, I think, because it depends on their products. They might be very successful with one product and then make huge gains, and then maybe other products are not performing that well. So it's a very, very risky investing in a pharmaceutical company because things can go bad really quickly. Another one here, MO, cigarette giant. Cigarettes again is there's a lot of restriction on smoking in many countries, so they're saying here declining volumes, which is not surprising. So investing in this kind of companies with maybe high dividend yield is very risky. Now let's see another one, CWH. I never heard of this company, but let's see what kind of issues. Demand is rapidly declining, so again earnings might not be that good. So this is just I'm not going to focus on this company. It's just an example to really stress the importance of the research, because a lot of these companies are also cyclical, like oil, like commodities. They could have maybe a bull run for 10 years and then they do nothing for another 10 years, so it's really tricky. Maybe again, diversify is important. Don't put everything in one sector, even if it's maybe you think is gonna do very well because of inflation probably or other reasons. So be careful, do your own research, and I think some of these dividend stocks are definitely interesting. I would keep it as a maybe small part of your portfolio. I think you can do better than investing maybe in tech stocks over the long term, but it's a personal preference. Some people prefer to have a steady income guaranteed every month, and for them these kind of investments are definitely the best. Thanks for watching this video. If you like more of this content, please subscribe. Bye for now.